Well, this is the lowest interest rates have been in 3 months. So we are starting a nice trend downward. Will it continue? We're going to talk about it today. Well, let's see. Today is November 30th, Thursday. I hope you're doing well. We've got some welcome news, y'all. We are sitting today in the Mortgage News Daily Tracking Poll of national 30-year rates, 7.15%. Y'all, that's down little over 3/4 of a point from where we were 30 days ago. We were sitting at 7.92% in that same survey. 2 weeks ago, we were at 7.36. So we're down about 1/8 of a point, a little over 1/8 of a point in the last 2 weeks. And this is all very welcome news. The bottom line is, folks, we are seeing inflation numbers that are coming in as expected, if not a little bit better. Today's big report was the Personal Consumption Expenditures Report. This is the Fed's favorite gauge of inflation. It's the one that they are basing policy decisions on more than any other reporting. It came in as expected. The most important aspect of that report, the Fed looks at the 6-month rolling average of inflation to see what their target rate should be. We're sitting right now at 2.4% in that 6-month rolling average. That is only 0.4% above the Fed's consistently stated target of 2% for inflation. So we're getting close to where we should be from an inflationary standpoint as far as the Fed is concerned. And they may view that what they've done already as being sufficient to get us there. There is some slowdowns in the labor market that suggest that's very much the case. We may be entering a recession, the depth of which will only be determined after we've climbed out the other side of it. So we will see if that is in fact the case, or if they have achieved this Goldilocks miracle of a soft landing in such a way that we don't see a downward revision in 2 back-to-back quarters of GDP. Especially in light of the strength of last month's GDP number. We did see interest rates increase a hair over yesterday. Yesterday, we hit a nice low, y'all. We were down 7.1 range yesterday. We're a little bit higher than that today. Part of that is we've hit right at the 200-day moving average as far as the price of mortgage bonds. That is a really tough ceiling to break through, y'all. Bonds are really finding resistance at that level. It's a technical level, but it's one that traders set. So a lot of electronic trading centers around these ceilings of resistance. A lot of individual traders will set those as sell and buy points, and you're seeing that resistance being offered. But also, we've got tremendous pressure from the Dow just as a competing place for investor dollars. The Dow's up nearly 1%. Actually, it's up a little over 1% today. So we're seeing nice rallies in the Dow. In fact, you've got to go up to January of 2022. We're sitting 23 months. You have to go backwards to see the Dow at a higher closing level than it is right now. So we've seen beautiful rallies in the Dow. It's been a tremendous November. Normally that would put significant pressure upward on rates because, again, we've got investors competing. We've got the same dollars competing for equities and bonds. And even in the light of that, we've seen nice improvement in bonds. Does that mean that we're going to see a continuation of this? Well, it may. Folks, when folks are looking down the lens of where the Fed is going to be, where monetary policy is going to be, where the market is going to be, all signs seem to be pointing more towards rates improving versus rates increasing. And that is very good news. Let's talk about house prices, y'all. As we have mentioned on this call several times, we have a number of buyers that are expecting a 2007 to 2011 type of deflation in the housing market. I've gone through some of the reasons why we will not likely see that. The circumstances that are contributing to the current market just frankly don't exist today as they did back in 2007. Most importantly, there were 4 million houses on the market back then, and there's less than 1 million houses on the market today. So just a pure supply and demand analysis of the market says we're not going to see house prices trend dramatically lower, if lower at all. Case-Shiller came out yesterday. House prices increased 0.7% in September, annualized rate of 3.9% year over year. That houses have appreciated nationwide. Now, again, every market's local. It's quite a bit different in my market than it is nationwide. But when you look at the national number, houses are clipping along at a near 4% appreciation rate, even in the face of dramatically higher interest rates from where we were 12 months ago. As we start a trend downward in rates, if in fact that's where we are, if we have hit the high watermark in rates, and if we are now seeing rates start to trend downward, then we have a very short window where we have some softness in the market that is allowing for significant buyer concessions. Again, the contracts that I'm receiving now have significant buyer concessions on most, if not all, of those contracts. Will that continue as rates come down? Well, folks, we're down almost a point in the last 30 days. If that trend continues for any significant period of time, then the market will heat up significantly. And with inventories as low as they currently are, again, fewer than 1 million homes for sale currently, that's going to push those concessions out of the marketplace. But we're still going to have interest rates that may well be refinanceable a year or two down the road. So the bottom line is, if you're looking at refinancing a house 2 years from now, regardless of whether they improve a half or a full point from here, then don't you want to buy one while you can get what you want, build the concessions in that the current market is allowing, so that you don't get hung out to dry on a much higher price point with zero concessions when we see these interest rates start to drop and more buyers jumping off the fence to get back in. Tremendous pent-up demand over the last 12 months, y'all, from folks that have been sitting back just not wanting to try and grab a falling knife with regard to housing. So interesting to see the market that we're in right now. I hope folks take advantage of an opportunity to grab the house that they want while they can still get some concessions on it, because if rates continue on their trajectory downward as we're seeing now, those concessions are going away. And then you're going to be competing with a lot more buyers than today. So in any event, that is the advice I'm giving buyers. Buy now, grab any concessions you can get, refinance when the market allows for it. Don't worry about where interest rates are in the future, because you can always take advantage of them. Refinancing is a thing. In any event, hope this is helpful for you and for your clients. As always, you can find my information. It's all on the screen. We do operate these calls in the hopes that we generate your referral business. We do mortgages here. We do them extremely well. Over 200 5-star reviews. Happy to share that link with you as well. Google me online. You'll find all of them there. Honored to do business with you all. Have a great week. Stay blessed. Stay safe. We will talk to you next week.